When I look back at the moment I first put a $100 bill into my trading account, I almost laugh at how little I understood and how much fear I carried with me. It was 2026. Inflation was biting. Markets felt unpredictable, and everyone around me seemed to have an opinion about money. Some said the stock market was gambling, some said crypto was dead, and others said the only way to build wealth was by inheriting it. But I didn't have wealth, I didn't have connections, and I certainly didn't have any miracle plan. What I did have was curiosity, a hunger to escape the paycheck-to-paycheck life, and $100 I was ready to risk if it meant learning something real about money. I remember staring at that tiny balance, $100, a number so small that it felt almost insulting to the grand idea of becoming wealthy. But something clicked in me that day. I realized the amount didn't matter. What mattered was creating the mindset and habits of someone who builds wealth. And that became the foundation of everything that followed. Most people think the story begins with a magical investment, a lucky stock or a secret strategy. But mine began with discipline. Before touching a single stock, I spent weeks learning, not from influencers shouting about 100 times coins, not from viral shortcuts, but from the philosophies of real investors. People like Benjamin Graham, Warren Buffett, and especially Charlie Munger. Munger's simplicity stood out to me. Avoid stupidity, stay rational, and buy wonderful companies at fair prices. I wasn't smart enough to predict markets, but I could follow rules that smarter people had proven for decades. The first rule I adopted was patience, an investment superpower people underestimate. With $100, my goal wasn't to double it in a week. My goal was to build a portfolio that made sense. My first real investment wasn't glamorous at all. I picked a boring, undervalued company, something all the hype-driven people ignored. It was a business with stable cash flow, low debt, and a long track record of weathering economic storms. The stock had dipped due to short-term panic, not long-term weakness. And that's where my $100 went. I bought fractional shares because I didn't need a whole share to begin my journey. The moment I clicked buy, something changed inside me. Suddenly, I wasn't just an observer of the market, I was a participant. Even if tiny, I was in. I watched how the market moved, not with fear, but with fascination. Every rise taught me about momentum, every drop taught me about emotion, and every sideways movement taught me about patience. But let me tell you something honestly, that first investment didn't change my life. What changed my life was the habit that followed. Because that initial $100 wasn't the end. It was the foundation. I made a rule every week, no matter how small, I would add something to my investment account. Sometimes it was $20, sometimes $5, sometimes $50. The amount never mattered. The consistency did. I treated my portfolio like a plant. I watered it regularly, and I didn't dig it up every day to check the roots. Over the next few months, I studied deeper. I learned how to read balance sheets, how to use PE ratios, how to identify competitive advantages, and how to spot insider buying. I learned why many people lose money, not because markets are unfair, but because their emotions control them. I learned to observe my fear and greed before making decisions. My strategy became simple. Find undervalued companies with strong fundamentals and buy them slowly over time. If the price dipped further, I didn't panic. I accumulated more. Instead of hoping for quick returns, I built positions in companies I actually understood. At the same time, I avoided high-risk speculation. No meme coins, no random penny stocks, no friends' tips, no chasing hype. Every time I felt tempted, I would go back to Charlie Munger's quote, "The big money is not in the buying or selling, but in the waiting." And I waited. Months turned into a year. I kept adding small amounts. I reinvested every dividend. I ignored market noise while others panicked during short-term volatility. I saw opportunities. Whenever the market dipped, I treated it as a sale rather than a disaster. My $100 had quietly grown to $450. Not a lot, but something important had happened. My knowledge had grown even faster. I now understood compounding, not just mathematically, but emotionally. I had learned to trust the process. As 2026 progressed, my confidence grew. I diversified slightly, adding a tech company with strong earnings growth, an energy company with stable dividends, and a consumer goods company with massive brand loyalty. Each one had a reason: solid fundamentals, undervalued metrics, and long-term potential. Then something unexpected happened. One of my undervalued stocks suddenly exploded. Not because of hype, but because the company announced a breakthrough partnership and stronger than expected earnings. In 1 month, it grew 52%. That was the first time I really felt the power of patience. That single stock lifted my entire portfolio. But it wasn't luck. It was preparation meeting opportunity. My portfolio crossed $1,000. The same people who laughed at my $100 beginning now started asking me how I was doing it. But I wasn't doing anything special. I wasn't chasing trends. I was simply following principles that wealthy investors had followed for decades. With growing experience, I shifted part of my strategy toward long-term index funds. Why? Because even great stock pickers admit it's nearly impossible to beat the market consistently. So I began putting a portion of my weekly contributions into broad market ETFs. These gave me instant diversification and reduced risk while steadily growing over time. By year 2, something magical happened. Compounding took over. My earlier investments began growing on their own. Dividends that were once pennies had become dollars. I reinvested everything. I didn't cash out even once. The money began making money. The portfolio crossed $5,000, then $10,000. This stage was transformative because I realized something deep. I wasn't getting rich because of one smart investment. I was getting ahead because of consistent discipline. I didn't rely on motivation. I relied on systems. Around this point, I also made a critical shift in mindset. I stopped trying to time the market. I stopped predicting tops and bottoms. Instead, I followed a slow and steady dollar-cost averaging strategy that protected me from volatility and allowed me to accumulate assets without stress. As my experience grew, my mistakes also taught me valuable lessons. I bought a small position in a company that looked promising but carried too much debt. When interest rates rose, the stock tanked. Instead of panicking, I studied what went wrong. That mistake made me even more selective with future investments. Slowly, I refined my ability to identify long-term compounders, companies with competitive moats, strong free cash flow, healthy balance sheets, and management teams focused on sustainable growth. I learned to avoid noise and pay attention to fundamentals. By now, my portfolio had crossed $25,000. I was earning more from investments than I used to make in a month at my old job. My money was no longer just saved, it was working. But remember, the journey was never fast, it was steady. And that steadiness became my superpower. The jump from $25,000 to $50,000 happened faster than the jump from $100 to $1,000. That's how compounding works. The larger your base, the faster it grows. And each time the market dipped, I didn't see danger. I saw discounted prices. Then, a few years into my journey, the moment arrived that still gives me chills. The portfolio crossed 100,000 Indian rupees in value. Yes, the same portfolio that started with just $100. It didn't happen overnight. It didn't happen because of luck. It happened because small decisions repeated consistently over time turned into massive results. And that is the core truth. Wealth is not built by trying to get rich quickly. Wealth is built by learning, investing regularly, being patient, avoiding stupidity, and allowing compounding to do its work. The strategy that turned $100 into 100,000 Indian rupees wasn't magic. It was painfully simple. Spend less than you earn. Invest consistently. Ignore noise. Buy quality. Hold patiently. Let time do the heavy lifting. Today, whenever someone asks me how to start investing, I tell them the same thing. Don't focus on the number you start with. Focus on the habits you build. Because the habits you create with $100 are the same ones that will one day manage $100,000. Or even $1 lock. Or even more. And if my journey proves anything, it's that anyone can start small and still win big. As my portfolio crossed the 100,000 Indian rupees mark, something shifted inside me in a way I didn't expect. It wasn't pride, it wasn't excitement, and it wasn't even relief. It was clarity, the understanding that wealth is not an event but a lifestyle. It's not a finish line but a direction. What I had, if it wasn't a fortune, but it was meaningful because it represented a mindset I had never possessed before. Growing up, money always felt like luck or chance or something given to people with advantages I didn't have. But now I understood that wealth responds to discipline far more than it responds to privilege. After hitting that milestone, I didn't slow down. In fact, I became more obsessed with improving my decision-making rather than increasing my contributions. I realized that strategy compounds just like money does. Better habits created better allocations, better warnings, better patience, and better understanding. Investing was no longer something I did. It became part of who I was. With a stronger foundation, I began analyzing the market differently. I started studying how economic cycles worked, how interest rates influenced valuations, how inflation affected different sectors, and why some industries collapsed while others thrived. I realized that individual stocks behaved like characters in a story. Each one had problems, strengths, heroes, villains, and unpredictable chapters. If you paid attention long enough, you learned their personalities. Some stocks panicked too easily. Some grew slowly but reliably. Some shot up like fireworks only to fade just as quickly. And a few, very few, behaved like long-term companions you could trust through storms and sunshine. I focused more on identifying those companions. At the same time, I became far more intentional with my spending in real life. This surprised me because before investing, I never cared about budgets. But once I saw what a small contribution could grow into over years, I started valuing every dollar differently. A random 200 Indian rupees snack wasn't just a snack anymore. It was part of my future being eaten away. 1,000 Indian rupees impulse purchase wasn't harmless. It was loss compounding. Slowly, my financial discipline outside the market strengthened my discipline inside the market, and both fed each other. One of the most powerful lessons hit me when a global market correction happened. Suddenly, nearly everything fell. My portfolio dropped hard, not just a little. I'm talking about days where it was down 8%, 10%, even 12% at one point. Watching weeks of gains vanish in hours was a punch to the chest. The younger version of me, the one who knew nothing about investing, would have panicked and sold everything. But now I was different. I had studied too much and practiced too long to let fear control me again. Instead of panic, I felt something unusual: excitement. This was the first true test of my conviction. This was where all those late-night reading sessions, all the books, all the long-term mindset practices finally mattered. I reminded myself that every great investor I admired once said the same thing: markets reward the patient and punish the emotional. So I bought more, slowly, carefully, and only in the companies I truly understood. I didn't go all in. I didn't gamble. I simply continued my discipline at a time when most people froze. When the market recovered months later, not days, not weeks, my portfolio surged far beyond its previous high. That correction became one of the biggest boosts to my long-term growth. It taught me that real wealth is built in downturns, not upswings. Anyone can invest when everything is rising, but only the disciplined can invest when the world is panicking. It was after this experience that my strategy evolved once again. I started combining long-term dividend stocks with growth stocks in a more intentional ratio. Dividend stocks gave me stability and cash flow, while growth stocks gave me long-term appreciation. This mix made my portfolio feel balanced, like a team where every player had a role. Around this time, I also developed the habit of journaling every investment decision I made, not to track profits, but to track my reasoning. I wrote down why I bought something, why I sold something, what emotions I felt, and what information guided me. This habit quietly changed everything. I started catching my own biases. I noticed when I was becoming impatient. I noticed when I was tempted by hype. I noticed when I was ignoring warning signs. The journal became a silent teacher. My contributions, still small, still consistent, continued. But now my portfolio had momentum. The snowball was rolling faster. What once took a year now took months. What once took months now took weeks. Compounding was no longer a theory, it was visible right in front of me. The dividends I received in a month were more than I used to invest in a week. Some stocks had tripled. Others had grown slowly but steadily. A few had been sold after underperforming, but overall, the direction was always upward. During this stage, something else changed. I stopped comparing myself to other investors. In the beginning, I would see people making massive returns overnight and feel insecure. But over time, I realized that comparing portfolios is like comparing life paths. It's pointless. Some people start with capital, some start with knowledge, some start with connections. I started with none of that, but I had discipline, and that turned out to be more valuable than anything else. One thing that people rarely talk about is how boring real wealth building actually becomes. There's no fireworks, no dramatic leaps, no Hollywood-style moment where everything changes. It's quiet, it's repetitive. It's the slow and steady accumulation that feels almost invisible until one day you wake up and realize your life has changed. And that's exactly what happened. My portfolio crossed 150,000 Indian rupees, then 200,000 Indian rupees. Suddenly, I realized I was no longer building just an investment portfolio. I was building a financial identity. Money no longer controlled me, I controlled it. And that sense of control is something I wouldn't trade for anything. By this point, I could look at a company's financial report and understand it the way someone else understands a movie plot. I could read cash flow statements like chapters. I could sense when a business was strong long before its stock price reflected it. This was not talent, it was practice. And I began to see how the world truly works. The market rewards those who understand businesses, not those who follow trends. One of the biggest turning points came when I made an investment that I held even when everyone else called it boring. It wasn't flashy, it wasn't hyped, it wasn't talked about by YouTubers, but it had consistent earnings, stable dividends, and a long-term upward trend. Everyone ignored it because it wasn't exciting enough, but boring businesses often build exciting wealth, held that stock, accumulating month after month. And then, 1 year later, it nearly doubled. That one decision alone accelerated my portfolio growth more than any risky trade could have. It reinforced the idea that simplicity is not weakness, it's wisdom. As my balance grew, something else happened. I began understanding the emotional side of wealth. Money gives you options. Options give you confidence. Confidence gives you calmness. And calmness helps you make better decisions. It was a cycle I had never experienced before. My life became less stressful, not because I was rich, but because I was financially stable. Whenever someone new asked me where they should start, I always said the same thing. Start with your mindset and OT your money. The smallest amount can grow if the mindset is right, and the largest amount can disappear if the mindset is wrong. Looking back, that first $100 wasn't just money, it was a seed. And the most important lesson I learned is that seeds only grow when they are planted, watered, and given enough time. If you're watching this and you want your financial life to change, you don't need to wait for the perfect moment. You don't need a huge starting amount. You don't need to predict markets. You need discipline, patience, and the courage to start even when the number feels small. Because wealth doesn't begin with money, it begins with intention. After my portfolio crossed the 2 lakh mark, I began to notice something unusual about my relationship with money. In the beginning, every gain felt explosive, every increase felt like a victory, and every dip felt like a personal attack. But as the numbers grew bigger, I realized I was no longer emotionally reacting to them the same way. Earlier, a 200 Indian rupees drop used to ruin my mood. Now a 2,000 Indian rupees drop barely moved a muscle on my face. Not because I didn't care about my money, but because I finally understood how meaningless short-term fluctuations are in a long-term journey. I had changed more than my portfolio had. This emotional evolution was something nobody talks about. Everyone talks about profits and returns, but nobody explains how your mind reshapes itself once you start seeing money as a tool instead of a master. With every investment decision, I wasn't just building wealth, I was building resilience. A calm mind became my biggest asset. This calmness allowed me to make decisions that the earlier version of me could never have imagined making. At this stage, I also started analyzing global markets more deeply. Not because I wanted to trade internationally, but because understanding world events helped me. See how interconnected everything was. A small policy change in the U.S. could influence tech stocks across Asia. A geopolitical issue in Europe could affect crude prices, which then affected energy stocks everywhere. For the first time, I realized that investing wasn't just about charts or prices. It was about understanding how the world itself functioned. And once I started seeing the world through that lens, every headline became a clue, every policy became a signal, and every major event became an opportunity hidden behind uncertainty. Even though my contributions were still modest, something else had begun to happen. People around me started seeking my advice. At first, I hesitated. Who was I to guide someone? I wasn't some millionaire guru. I was just a disciplined investor who started with $100. But then I realized that most people didn't need a millionaire to guide them. They needed someone who understood what it felt like to start small. Someone who didn't talk in big, complicated terms. Someone who knew the struggle of budgeting, the fear of investing, and the doubts that come with every decision. When friends asked me where to put their money, I didn't tell them what to buy. I asked them questions instead. What are your goals? How long can you stay invested? How much volatility can you emotionally handle? These questions made far more difference than any stock recommendation could. Some were shocked when I told them that their mindset mattered more than their money. A few understood it. Most didn't. But that's the thing about investing. Only a few people truly embrace the boring, disciplined path that actually works. As my experience grew, I started recognizing patterns in investor behavior. Most people would get excited at the absolute worst times. They would buy when markets were euphoric and sell when they were fearful. They would chase rising stocks and abandon falling ones. Meanwhile, I did the opposite. And that single difference made years of impact. The next big shift happened when I increased my focus on reinvesting dividends. Earlier, I used to see dividends as a small bonus. But now, with a larger portfolio, even a few percentage points of dividends began turning into significant amounts. Each payout, no matter how small, was immediately reinvested. It was like watching a tree drop seeds that grew into more trees. Eventually, those trees began producing fruit too. Compounding wasn't just math anymore, it was a living ecosystem inside my portfolio. Another major turning point came when I learned to avoid over-diversification. In the beginning, I spread my investments too thin because I thought more stocks meant more safety. But over time, I realized that too many choices dilute attention. You cannot monitor everything. You cannot understand every business deeply. I began trimming down the portfolio to focus only on the companies I understood well. Every remaining stock had a purpose, a story, a reason for being there. It was like cleaning a room. Removing clutter made the whole space clearer. Around this time, I also faced one of the hardest investing moments of my journey. A company I had trusted for 2 years went through a sudden earnings decline. Its leadership changed. Its long-term outlook became uncertain. The price fell sharply. I waited, studied, analyzed. But eventually, the data told me something my emotions didn't want to accept. The company was no longer the same investment I had originally bought, so I sold it at a loss. And what surprised me wasn't the loss itself. It was how little it bothered me, because I finally understood something profoundly important. Losing small is better than losing big, and admitting a mistake early is better than waiting for the market to punish your stubborn. That was one of the most mature financial decisions I ever made. As the months passed, my income grew slightly due to promotions and side work. Almost all of that increased income went straight into investments. I wasn't living a miserly life, but I wasn't chasing unnecessary lifestyle upgrades either. The old me might have bought fancy gadgets or expensive outings. The new me saw those things as momentary comforts that cost long-term opportunities. Money had become a soldier working for me, and I wasn't going to waste it on battles that didn't matter. Then came a year where everything aligned. The market was recovering, my contributions were consistent, dividends were growing, and my understanding of value was sharper than ever. My portfolio doubled faster than I expected. Watching it cross the 3 lakh mark was a surreal moment. It felt like watching a child grow up. Slow at first, then suddenly fast. I also started experiencing something subtle but powerful: financial confidence. Not arrogance, not pride, just confidence. Confidence that even if I lost my job, even if life threw unexpected challenges, I would still be okay. Safety net wasn't just money, it was the understanding of how to rebuild it again if needed. Knowledge became the real wealth. During this period, I also learned the importance of staying private about my financial progress. The more people knew, the more opinions I had to deal with. Everyone suddenly became an expert, telling me where to invest, what to sell, what they heard was going to crash, or which hot stock was going to explode. I learned to politely nod and ignore. Wealth grows best in silence. One of the most rewarding things I did was automate part of my investing. Automatic transfers removed the emotional hesitation. Whether the market was crashing or booming, the money went in consistently. It was like removing own weakness from the process. This single automation improved my results more than any complex strategy ever could. Another realization hit me hard when I saw a CO worker trying to time the market. They waited for the perfect dip, for months watching prices rise while holding cash helplessly. Meanwhile, my slow, steady contributions continued. When they finally bought in, the prices were much higher. That day, I understood why dollar cost averaging works better than overthinking. As my portfolio crossed higher milestones, my view on life also began changing. I valued time more. I valued peace more. I valued learning more. Oddly enough, the more money I accumulated, the less desire I had to show it. My priorities shifted from wanting impressive things to wanting an impressive future. At this stage, I also became obsessed with analyzing competitive moats. Every company I invested in had to offer something difficult for competitors to copy, whether it was brand strength, distribution power, patents, customer loyalty, or network effects. The moat mattered because moats protect profits. They make businesses resilient. They turn ordinary companies into compounding machines. This shift in thinking helped me avoid many risky plays. While others jumped into high volatility businesses hoping for quick returns, I invested in companies that had quietly dominated their industries for years. These companies didn't trend on social media, but their balance sheets were rock solid. One of the most eye-opening moments came when I realized that my portfolio was earning more passive income annually than I used to save in a year. That was a revelation. The idea that money could earn more money without me working extra hours changed everything. It was like discovering a secret staircase inside a building everyone thought had only one floor. As time passed, I watched friends upgrade lifestyles faster than their income. They earned more and spent more. Bigger phones, bigger bikes, more restaurants, more subscriptions. Their bank balances stayed the same. Meanwhile, my lifestyle remained simple, but my net worth kept climbing. This wasn't sacrifice, it was strategy. The ability to delay gratification became my strongest competitive advantage. Eventually, the market entered a period of volatility again. This time, instead of fear, I felt excitement. Drops felt like opportunities, not threats. Every dip reminded me of how far I had come from the anxious beginner who once trembled when his $100 fluctuated. Now I calmly bought more shares of companies whose long-term stories were still intact. During this period, I also discovered that one of the hardest things in investing is doing nothing. Patience is uncomfortable. Waiting feels like laziness. But in reality, waiting is the work. Holding is the work. Resisting impulsive trades is the work. Long-term investing isn't passive. It is actively fighting your own emotions. And every time I won that fight, my portfolio rewarded me months later. The next milestone approached quietly, a number I had once considered impossible. My portfolio crossed the 4-lakh mark, then 5. It didn't happen because of a single big win. It happened because of hundreds of small, disciplined decisions stacked on top of each other like bricks, brick by brick, habit by habit, month by month. Wealth grew. And then one day I realized something profound. The same strategy that turned $100 into 100,000 Indian rupees was now turning 100,000 Indian rupees into multiple lakhs, and would eventually turn lakhs into millions.